another strong quarter for financial markets, and that continued the strong run for markets that we'd seen through the course of 2017. Markets continue to be driven by reduced volatility that we've seen over the course of 2017, as well as sort of increasing complacency about the risks that markets potentially face. The quarter started off with the Chinese convention, and the lack of negative headlines from that suggests that GDP growth from China will continue to be strong, and that should be a benefit for commodity prices, which will benefit us here in Australia. Secondly, we saw the announcement of a new US central bank governor. His appointment means that we're likely to see very few surprises in terms of interest rate hikes going forward, and again that should support the markets from where we are today. And thirdly, late in the quarter we saw the US come out with their much talked about tax cuts. Those tax cuts are expected to be a benefit for both corporates and the global economy, and investors have started to price that into financial markets, seeing equity markets continue their strong run. So the strong returns that we saw from equity markets over the quarter has meant that the portfolios continue to exceed their long-term investment objectives over both a short and longer time frames. The portfolios continue to be positioned towards those markets which we think are going to deliver the best reward for risk for investors. So that sees us favouring emerging markets over developed markets. And over the course of the last quarter in 2017, we saw emerging markets continuing to outperform developed markets like the US. Also, we continue to favour Japan. We think this is a market which will benefit from the continuing reforms which are ongoing in the country, and that also performed the broader US market, so that delivered a strong benefit to the portfolios. And thirdly, other parts of the portfolio, like exposure to alternatives, has continued to deliver good outcomes for the portfolio in a risk-controlled way. So with the strong returns that we've seen from markets over the last couple of years, we see valuations becoming increasingly expensive. So on that basis, we're looking to focus the portfolio to those asset classes which we think will give us the best reward for risk looking forward. So on that basis, we think regions like the emerging markets and Japan give us the best opportunity to help us continue delivering returns in line with investors' investment objectives. Also, we continue to hold higher levels of cash in the portfolio than what we would normally. We believe that sort of cash is one of the few asset classes which can protect capital with 100% certainty. Bonds, which we've traditionally looked to protect the portfolios, given their expensive valuations, offer the real risk of delivering a negative return, particularly if interest rate rises continue to play out, as many of the central banks around the world have suggested they will.